South Africa's economy is projected to grow by 1.6% in 2026. That's up from 1.4% last year. This was confirmed by Finance Minister during the 2026 budget presentation in Parliament, as reported by Mail and Guardian. But beyond the headline number, what exactly did the minister cover? And more importantly, what does it mean for ordinary South Africans? Let's break it down. 1. Economic growth outlook. The minister confirmed GDP growth was 1.4% in 2025. A growth is expected to improve to 1.6% in 2026. Over the medium term, growth could reach around 2% by 2028. This signals gradual recovery, not a boom, not a crisis, but slow stabilization. However, at 1.6%, the economy is still growing too slowly to meaningfully reduce unemployment. South Africa typically needs growth above 3% to create jobs at scale. 2. Electricity and infrastructure improvements. One of the biggest improvements mentioned was reduced electricity disruptions. Compared to previous years of severe load shedding, power supply has stabilized. Rail and port operations are also improving, which is critical for mining, agriculture, and exports. This matters because when infrastructure works, businesses can operate more efficiently, and that supports growth. 3. Fiscal discipline and budget deficit. The minister emphasized fiscal consolidation. The budget deficit is expected to narrow gradually. Government debt, which surged over the past decade, is projected to stabilize. This is important because lower deficits reduce borrowing pressure. Stabilizing debt improves investor confidence. It helps protect South Africa from credit rating downgrades. Through the National Treasury, government plans to introduce a stronger fiscal anchor, a rule-based framework to control spending and debt long-term. In simple terms, government is trying to prove it can manage money responsibly. 4. Inflation and household impact. While inflation pressures have eased compared to previous peaks, households are still feeling strain. The moderate growth forecast suggests wage growth will likely remain slow. Tax relief will be limited. Government spending increases will be cautious. There were no dramatic stimulus measures announced. This budget leans towards stability, not aggressive expansion. 5. Risks highlighted. The minister acknowledged several risks: a high unemployment, weak global economic conditions, infrastructure constraints, agricultural risks such as foot and mouth disease, ongoing municipal service delivery failures. These risks could slow growth further if not managed properly. 6. What this means for South Africans. So, what does all this mean in practical terms? For workers, job growth may improve slightly, but unemployment will likely remain high. For businesses, there is improving stability, but demand will remain moderate. For investors, debt stabilization and fiscal discipline may support the rand and bond market. For everyday households, expect gradual improvement, not rapid transformation. This is a stabilization phase, not a turnaround, not a crisis, but a slow rebuild. 7. The bigger picture. The key takeaway from the minister's budget is this: South Africa is trying to move from crisis management to structured recovery. The challenge is that 1.6% growth is not enough to significantly reduce inequality or poverty. The real question is whether structural reforms in energy, logistics, and fiscal management can push growth above 3% in the coming years. Because without stronger growth, unemployment remains the country's biggest economic threat. To conclude, South Africa's 2026 budget sends a message of cautious optimism. The economy is improving, debt is stabilizing, infrastructure is slowly recovering. But the country is not out of the woods yet. The difference between 1.6% and 3% growth is the difference between stability and real transformation. And that is the conversation South Africa must now have.